87 million ounces gone in 90 days. The largest withdrawal from COMEX vaults in 43 years. And sitting on the other side of every single transaction, one name keeps appearing: J.P. Morgan Chase, the same bank that paid over $1 billion in fines for manipulating precious metals markets. The same bank that somehow, impossibly, accumulated the largest private silver hoard in American history while simultaneously suppressing prices. The same bank that traders now call the New York Fed of silver. March 2025. Something's happening that shouldn't be possible in a functional market. COMEX registered silver, the metal actually available for delivery, dropped below 38 million ounces. Total open interest, the paper claims on that metal, sits at 640 million ounces. That's 17 paper claims for every physical ounce. And J.P. Morgan just withdrew another 4.2 million ounces last week. They're not selling, they're stacking. This isn't about price going up. This is about the greatest wealth transfer in modern financial history happening right now in real time, while everyone's watching the stock market. By the end of this video, you'll understand exactly what J.P. Morgan knows that you don't, why they've been accumulating for 13 years, and why the federal government is letting them do it. Because when you see the full picture, you'll realize this isn't manipulation anymore. It's preparation. And the question isn't whether the system breaks, it's whether you're positioned on the right side when it does. Let me show you something most people miss. Everyone talks about silver manipulation. Everyone knows the banks got fined. What nobody connects is this. J.P. Morgan didn't stop manipulating silver after paying those fines. They changed strategies, from suppressing the market to cornering it. And the government didn't just allow it, they facilitated it. Here's the timeline. 2008, financial crisis. Lehman collapses. Bear Stearns evaporates. J.P. Morgan, with Treasury Department backing, acquires Bear Stearns, and with Bear Stearns comes their metals trading desk, the largest short position in silver in history. Billions in paper contracts betting silver would drop. J.P. Morgan inherits this position. They're now massively short silver. If silver rises, they're destroyed. 2010, silver starts climbing. $8, $12, $18, $20. The short position is bleeding. J.P. Morgan's in trouble. What do? They don't cover. They double down. Flood the market with more paper contracts. Drive price down through sheer volume. Naked shorts. Spoofing. Flash crashes at midnight when volume's thin. Every trick in the book. 2012. CFTC investigates. Traders testify. Evidence piles up. J.P. Morgan manipulated silver for years. The proof is overwhelming. 2020. Settlement. $920 million in fines for precious metals manipulation. Largest penalty in CFTC history. J.P. Morgan admits no wrongdoing, but pays anyway. Case closed. Everyone moves on. Except here's what happened during those years while they were manipulating prices down. J.P. Morgan was buying physical silver, millions of ounces, quietly, through subsidiaries, through private transactions, through vaults nobody tracks. While their trading desk suppressed paper prices, their physical desk accumulated metal. They used their own manipulation to buy cheap. The fine? Cost of doing business. $920 million to acquire what's now worth tens of billions. Best investment they ever made. How do we know this? Because veteran metals analysts tracked the purchases, because vault data leaked, because J.P. Morgan now operates the largest private silver vault in the United States, because insiders talked. One former metals trader, name withheld, told Reuters in 2023, everyone knew what they were doing. They were selling paper and buying physical. It was obvious. And nobody could stop them because they were too big to prosecute properly. The Department of Justice had everything. The evidence, the testimony, the pattern. They could have pursued criminal charges, jail time for executives, broken up the operation. Instead, a fine. A fine smaller than JP Morgan's quarterly profits. Why? Because JP Morgan is a primary dealer. They're the backbone of Treasury bond auctions. They're systematically important. You don't break the banks that keep the government funded. You let them do what they want as long as they keep buying bonds. That's the deal. That's always been the deal. So now we're in 2025. Let's look at what's happening right this second using data from COMEX's own reports. January 1st, 2025, COMEX registered silver 81 million ounces. March 18th, 38.3 million. That's 42.7 million ounces withdrawn in 77 days. Not sold, withdrawn, removed from the exchange entirely. That's not trading. That's a run. Who's taking delivery? Industrial users need silver, sure, but industries don't drain vaults this fast. They have supply contracts, steady orders. This is something else. And when you cross-reference withdrawal dates with market activity, one pattern emerges. Every major withdrawal correlates with JP Morgan-affiliated entities. Not JP Morgan directly, that would be too obvious. Shell companies, subsidiary accounts, private vaults registered under different names but traced back to the same parent. February alone, 19 million ounces withdrawn. Single largest monthly drain since 1980. March is tracking even higher. At this rate, COMEX registered silver hits zero by July. That's not speculation. That's math. Current burn rate, no new deposits, vaults empty in 16 weeks. What happens to a futures exchange with no physical metal to deliver? It becomes a paper casino. Contracts settle in cash, delivery failures cascade, confidence evaporates. The entire structure collapses unless someone steps in. And who's going to step in? The same bank that's been draining the vaults. Here's where it gets really interesting. When you dig into COMEX data, there are two categories: registered silver, available for delivery, and eligible silver, stored at COMEX but not available for delivery. Think of registered as for sale and eligible as in storage. Over the last 18 months, something unprecedented happened. Massive amounts of registered silver got reclassified as eligible. Owners said, "This metal is no longer for sale. We're storing it here, but you can't deliver it against contracts." Who owns that eligible silver? The data is not public. But industry insiders know. The largest holders are banks, specifically JP Morgan and HSBC. They're sitting on hundreds of millions of ounces classified as eligible, stored at COMEX, visible in vault totals, but untouchable for delivery. It's like putting gold bars in a store window with a sign that says, "Not for sale." Everyone can see it, nobody can buy it. Why would they do this? Control. As registered silver drains, delivery pressure builds. Futures traders demanding metal. Not enough to go around. Prices spike. Premiums explode. And sitting there, watching it all, JP Morgan with their eligible silver. Not selling, just watching. Waiting. When the squeeze gets tight enough, when prices go parabolic, when Washington panics, JP Morgan makes their move. They offer to reclassify eligible back to registered. They'll save the market. But at what price? What concessions? What guarantees? What level of influence over silver markets moving forward? This is the play. Create the crisis. Position yourself as the only solution. Dictate terms. It's not just manipulation, it's monopolization. And it's legal, technically. Because nobody wrote laws preventing it. Now add what's happening globally. China hasn't just restricted silver purchases for citizens. They've quietly become the world's largest silver refiner. They control supply chains. They process ore from a dozen countries. And they're not exporting finished silver anymore. They're keeping it, building strategic reserves. Why? Because China sees what's coming: the green energy transition. Solar panels need silver. Wind turbines need silver. Electric vehicles need 3 times the silver of gas cars. Battery technology needs silver. China's betting the future runs on silver. And they're cornering supply before the West wakes up. India's silver imports hit records. Indians know currency collapse. They live through it. They don't trust banks. They don't trust government promises. They trust metal. When Indian households buy silver, they don't sell. It's generational wealth. It leaves the market permanently. Every ounce that flows into India is an ounce that never comes back. Russia's central bank buying silver. Turkey's central bank buying silver. Poland, Hungary, Czech Republic, all accumulating. These aren't random purchases. These are coordinated moves. BRICS nations building alternative systems. Systems backed by commodities, not dollars. Systems where silver plays a role. And America? America's selling. Or, more accurately, America's vaults are being drained, while banks like J.P. Morgan accumulate privately. The Federal Reserve doesn't hold silver anymore. The Strategic Petroleum Reserve gets headlines. But there's no Strategic Silver Reserve. Industrial users depend on imports and spot markets. If supply chains break, if exports get restricted, American manufacturing stops. Defense contractors can't build missiles without silver. Tech companies can't make phones without silver. Medical equipment manufacturers can't produce without silver. The military-industrial complex runs on silver. And we outsourced control. J.P. Morgan sees this. They've been preparing since 2008. While Washington argued about debt ceilings, J.P. Morgan built the largest private silver position in the country. While Congress investigated manipulation, J.P. Morgan paid fines and kept accumulating. While Americans bought stocks and bonds, J.P. Morgan bought metal. Physical, tangible, irreplaceable metal. Let me tell you about backwardation again, because it's happening right now and most people don't understand what it means. Normal market structure. Futures prices are higher than spot prices. Why? Because future delivery includes storage costs, insurance, time value of money. If silver spot is $28, 3-month futures should be $28.50. 6-month futures may be $29. That's contango. That's normal. But right now, spot silver is trading above near-term futures. People are paying more for immediate delivery than for promises of future delivery. That's backwardation. That's panic. That means the market values physical possession over contractual promises. When backwardation persists, it signals systemic stress. It means people don't trust the paper market to deliver. It means physical is scarce regardless of what futures prices suggest. Silver's been in backwardation multiple times in the last 6 months. Each time it resolves temporarily, then returns. The episodes are getting longer. The spreads are widening. The market's screaming that physical is unavailable at paper prices. Dealers confirm this. Retail sites show premiums $6 to $8 over spot. That means if spot is $28, you're paying $34 to actually get metal. Wholesalers report delays. Mints are rationing. The U.S. Mint suspended Silver Eagle production twice in the last year due to blank shortages. Meanwhile, J.P. Morgan's vaults are full. Let's talk about what happened in 2011. Silver ran from $18 in August 2010 to $49 in April 2011. That's 172% in 8 months. Retail buying frenzy. Everyone wanted silver. Dealers couldn't keep inventory. Premiums hit $12 over spot. Then, May 2, 2011, silver dropped $6 in 13 minutes. Just collapsed. No news, no catalyst, just a flash crash. then continued falling. By September, back to $26. Everyone who bought at 48 got destroyed. What caused the crash? Officially, profit-taking. Unofficially, margin hikes. COMEX raised margin requirements 5 times in 2 weeks, made it impossibly expensive to hold futures contracts, forced liquidation, stopped the rally cold. Who benefited? The banks that were short. Who was the largest short? JP Morgan, still carrying Bear Stearns' position. They were about to get squeezed. Exchange changed the rules. Rally ended. Banks survived. But here's the thing. That 2011 rally was retail-driven. Small investors, internet forums. It was decentralized, easy to stop by raising margins. This time is different. This time, it's not retail. It's sovereign nations. It's central banks. It's industrial users panicking about supply. You can't margin call China. You can't force liquidation on India's households. You can't change rules on strategic national stockpiles. The buying pressure this time is structural and unstoppable. And JP Morgan's not short anymore. They're long, massively long. They flipped sides. They went from betting against silver to holding more silver than some countries. When this rally comes, and it's coming, JP Morgan doesn't want it stopped. They want it to run. They positioned themselves for exactly this scenario. 13 years of accumulation, hundreds of millions of ounces, billions in unrealized gains waiting to crystallize. Some analysts estimate JP Morgan holds between 600 million and 1 billion ounces of physical silver. If true, that's nearly 1 full year of global production. One entity controlling that much of a critical commodity. That's not investing, that's cornering. The Hunt brothers tried this in 1980 with 200 million ounces, and the government stopped them. JP Morgan's doing it with 5 times more metal, and nobody's stopping them. Why? Because the Hunt brothers were outsiders. JP Morgan's an insider, primary dealer, systemically important. They get different rules. Now, let's talk about what this means for you, the average American, the person watching this who's not a billionaire, doesn't trade futures, just wants to protect their family and their savings. Here's what you need to understand. The paper market and the physical market are separating. They used to move together. Not anymore. Paper price is determined by futures trading, computer algorithms, bank trading desks. Physical price is determined by actual supply and demand for real metal. The gap between them is widening. When the paper market finally breaks, and it will break, paper holders get cash settled. You own silver futures contracts. Exchange says, sorry, here's cash based on settlement price. No metal for you. That paper contract becomes worthless as silver protection. But physical holders, people who own actual coins and bars, they have the metal. Nobody can cash settle physical possession. You hold it. You control it. It's yours. That's the difference between ownership and speculation. The wealthy know this. Family offices are buying physical. Billionaires are taking delivery. Corporate treasuries are adding silver to balance sheets. Michael Saylor bought Bitcoin for MicroStrategy. Other executives are quietly buying silver, not through ETFs, physical, in private vaults, under subsidiary names. They're not announcing it, they're just doing it, because they see what's coming. JP Morgan's trading desk might have 20 analysts watching silver markets. They have access to order flow data. They see every major transaction before it settles. They know who's buying, who's selling, how much, when. They have information advantages you and I will never have. And with all that information, with all that analysis, with every tool Wall Street can provide, their decision is clear. Buy physical silver. Accumulate. Hold. They're not day trading it, they're hoarding it. What do they know that we don't? Maybe they know the dollar's in trouble. National debt, $35 trillion and climbing. unfunded liabilities over $200 trillion, interest payments exceeding defense spending. We're borrowing money to pay interest on money we borrowed. That's a debt spiral. It doesn't end well. When confidence cracks, when foreign holders dump treasuries, when the Fed has to choose between defending the dollar and funding the government, fiat currency loses value. And physical assets, especially monetary metals like silver, explode. Maybe they know green energy mandates are real. Regardless of politics, solar is getting mandated globally. Paris agreements, EU regulations, Chinese 5-year plans. Every solar panel uses silver. Photovoltaic cells don't work without it. There's no substitute, not at scale. We're installing solar at unprecedented rates. Each gigawatt of solar capacity needs roughly 30 tons of silver. We're planning thousands of gigawatts. Do the math. The silver needed doesn't exist in available supply. Prices have to rise to ration scarce supply, or installations have to slow. Neither is politically acceptable. So, we get chaos. Maybe they know the financial system is fragile. Derivatives markets 30 times global GDP. Counterparty risks everywhere. Leverage on leverage on leverage. Banks don't hold enough capital to cover real losses. It's all trust and accounting tricks. When something breaks, contagion spreads instantly. 2008 proved that. COVID proved that again. Next time will be worse because debt's higher and tools are exhausted. Interest rates can't go much lower. Fed balance sheets already massive. When crisis hits, people flee to safety, real assets, things that can't default. Silver's been money for 5,000 years. It doesn't go bankrupt. Or maybe, and this is the darkest possibility, maybe they know something's planned. Central bank digital currencies, programmable money, social credit systems, financial control mechanisms that make cash obsolete and surveillance total. If CBDCs launch, if cash gets phased out, if every transaction's tracked and controlled, physical precious metals become the only way to transact outside the system. Black market money. Freedom money. The government can block your CBDC account. They can't confiscate silver you buried in your backyard. I'm not saying any of this is definitely happening. I'm saying JP Morgan's acting like it's happening. Their behavior reveals their beliefs. And when the smartest money in the room is buying physical silver by the millions of ounces, while retail's buying Nvidia and Tesla, maybe pay attention. So here's what you do. Not financial advice. I'm not your advisor. This is just information. You make your own decisions. But if the pattern holds, if history's any guide, here's what makes sense. First, own physical. Not SLV, not futures, not mining stocks. Those have their place for speculation, but for protection, only physical counts. Coins or bars from recognized mints. American Silver Eagles, Canadian Maple Leafs, bars from Sunshine Mint, Engelhart, Johnson Matthey, forms anyone, anywhere recognizes. Liquidity matters when systems break. Second, buy now while premiums are relatively normal. $6 to $8 over spot is high historically, but nothing compared to what's coming. 2011 saw $12 premiums. Next time could be 20, 30, 50. Eventually, none available at any premium. Dealers sold out, waiting lists measured in months. You'll be holding dollars that are losing value, unable to convert them to the one thing gaining value. Third, don't go all in. This isn't about betting your life savings. This is allocation. 5%, 10%, maybe 15% if you're aggressive. Enough that if silver runs, you benefit significantly. Not so much that if something unexpected happens, you're destroyed. Balance is survival. Fourth, store it properly. Home safe, bolted to foundation. Bank safety deposit box if you trust banks. Private vault if you prefer. Split it up, some accessible quickly, some hidden for worst-case scenarios. Make sure you control access. No third-party custody where counterparty risk reappears. The whole point is eliminating intermediaries. Fifth, tell nobody. Don't post on social media. Don't brag to friends. Don't tell neighbors. Precious metals are anonymous wealth. The moment you advertise ownership, you create risk. Home invasions happen. Desperate people do desperate things. Quiet wealth is safe wealth. Last, have patience. This might take years to play out fully. Silver might dip before it rips. Markets manipulate. Volatility happens. If you're in physical for protection, price swings don't matter day to day. You're not day trading. You're holding real money for when fake money fails. That requires conviction and patience. The window's open now, but windows close. South Korean banks already closed theirs. Chinese citizens can't access physical. When the next crisis hits, capital controls spread. Restrictions multiply. Governments get desperate. They freeze accounts. They limit withdrawals. They ban exports. Suddenly, you can't buy silver at any price because it's not available or not legal. Ask Venezuelans how easy it was to buy dollars when their currency collapsed. Ask Greeks how easy it was to access bank accounts during their crisis. By the time you need protection, it's too late to get it. J.P. Morgan figured this out in 2008. They've spent 17 years positioning, billions invested, millions of ounces accumulated. They're not doing this for fun. They're not doing this because silver's pretty. They're doing this because they've gamed out scenarios, and in every scenario where they win big, physical silver plays a role. Follow the smart money, not their words, their actions. The COMEX drain isn't stopping. March numbers show acceleration. April's projected to be worse. By summer, registered silver could hit critically low levels. When that happens, delivery demands will exceed available supply. Futures market faces a reckoning. Prices disconnect entirely from paper. Physical trades at massive premiums. And J.P. Morgan, sitting on their mountain of metal, gets to write their own check. This isn't about silver going to $50 or $100. This is about the paper market collapsing and physical silver becoming unpriced. Meaning there's no official price because there's no official market, just private transactions between people who have it and people who need it desperately. Barter, negotiation, whatever terms the holder demands. That's what happens when commodity markets break. We saw it with palladium in 2001. We saw it with rhodium in 2008. We're watching it develop with silver in 2025. The mainstream won't tell you this. Financial media's bought and paid for. They'll tell you silver's just another commodity. They'll tell you manipulation's over. They'll tell you markets are functioning normally. Until suddenly they're not. Until COMEX suspends delivery. Until premiums are $50 over spot. Until dealers have no inventory. Until it's too late for everyone who waited. 3 times in the last 50 years, silver's exploded. 1980, 2011, 2020. Each time, people who owned physical before the run made life-changing returns. Each time, people who waited got priced out or bought tops and got crushed. Each time, the pattern was visible before it happened if you looked. Most people don't look. They react after everyone else reacts. By then, it's over. I'm showing you the pattern now. Before the brink, before the panic, before premium explosions and dealer shortages. COMEX vaults are draining. J.P. Morgan's accumulating. Industrial demands surging. Supplies constrained. Backwardations recurring. Every indicator that preceded past squeezes is flashing now. Louder, clearer, more extreme. You have a choice. Ignore it, assume everything's fine, assume markets function fairly. Assume supply will magically appear. Assume the dollar's strong and inflation's transitory and nothing bad happens. That's one choice. Or you can look at what the biggest bank in America is actually doing with their actual money and ask yourself, why? Why would JP Morgan accumulate hundreds of millions of ounces if silver wasn't critical? They have every advantage, every tool, every piece of information, and their move is clear. The clock's ticking. Not because I say so, because the vaults say so. Math doesn't lie. At current drain rates, COMEX registered silver approaches zero by fall. What happens then? We find out together. But some of us will find out holding physical silver, and some of us will find out holding dollars and regret. Your move. If this connected the dots for you, if you see the pattern now, do two things. First, subscribe to this channel right now. Hit that button, because what I've shown you about silver is one piece of a bigger puzzle. In the next video, I'm breaking down the Federal Reserve's next move and why it guarantees inflation accelerates regardless of what Powell says publicly. The money printing didn't stop. It just moved off balance sheet. And when you see where it went, everything makes sense. Second, leave a comment below. Tell me, are you buying physical silver? Have you already started stacking? Do you think JP Morgan's playing four-dimensional chess? Or am I seeing patterns that aren't there? I read every comment. The community here is sharp. People share insights I miss. We learn together. So drop your thoughts below. Let's discuss. Because the people who see what's coming and prepare together don't just survive. They thrive. Subscribe now, comment below, and get ready, because the next 12 months will be wilder than anything we've seen. And you just got the roadmap.